Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. So good to have you aboard with us today. My name is Seth Krussman, joined here once again with Ben Brayshaw and Dan Mickelon. How are you guys doing today?
I'm doing great, Seth. How are you doing? How are you doing, Dan?
I'm doing good. Really good.
Good. I'm excited for the next couple of shows. This is going to be valuable information.
Yeah, tax season's always a big deal, and I think we've got some really relevant tips and things for you guys to watch out for, as we move into that and then work our way through 23.
Wow. So is the goal for us to help people pay more taxes this year? Am I understanding that correctly?
That's a complicated question, actually.
Depends on how many government services we're all going to be on.
And what your tax brackets are looking like, you might want to force some of that out sooner rather than later.
Right? Yeah. That's an interesting thing about that tax planning is some days part of tax planning ultimately might mean this year you're wanting to pay a little bit more than you did the last year. Either way, getting a plan around this is going to be a huge help for not only our clients, but you, our listeners. We do have a lot of fun and we do a lot of planning in this area. So it's going to be really some rich shows. That's the word that comes to mind, first of all, is these are going to be rich shows with very valuable information. And sometimes, what we're talking about doesn't have to relate with everybody, but believe it or not, when we talk about taxes, you're in that category of gonna relate.
Yeah, I think the thing about makes us really different is besides the three-dimensional planning and really what the core of that brings us to is that we do a lot of tax incentive planning. I mean, that's primarily our wheelhouse. We're not CPAs, but we work with so many people and have been in this business so long that, we really help people craft a different conversation around investments and what that means and how it translates into your overall tax play, which is really a hard thing to find in our industry. I think most people are just kind of like, here's our return. But the problem with return is that, depending on your tax bracket, a 7%, before tax return versus a 5% after tax return could be two different conversations depending on the bracket you're in and how that person's creating that. So if you're in a 30% bracket, you're going to want the 5% after tax. And that's the conversation that a lot of people don't really actually have with their clients. And if you're not really having that conversation in a comprehensive perspective of how is this involving it, if your financial planner is not asking for your tax return, if they don't want to see how things are moving for you in a tax relevant manner, you probably need to get some more advice, especially when you feel like you're paying too much in taxes. If you're listening, you say, I really feel like I'm paying too much in taxes, sit down with us. I mean, that's probably the first conversation you'd want to have with anybody. It's us.
Yeah, there's no doubt that the taxes and tax code in general is the one thing that we can say, for sure affects each and every client that we have. Everybody might have different investments, different goals, different time horizons, but we all have Uncle Sam sitting at the table, and he's always in for a piece. So understanding how to best navigate that and aim towards your best future outcome, that's why that advice that Ben was talking to is just critically important. It's not just about what you make, it's truly about what you keep.
Well, there you have it. That's the show for the next couple of shows here at Money on Tap, and we're going to be talking about some of these changes coming up in 2023. Surprisingly, not all of them are taxes going up, and that's going to be interesting as well. But before we get into that, it is time for Money in the News.
And first up today, coming to us from CNN by author Matt Egan, Americans are spending an extra $371 a month because of inflation. And I think we've all known this to be true at some level for all of us. Simply put, things cost more, and inflation is absolutely driving that. But kind of breaking down the impact on a per household basis is always interesting to see. And that number, $371 a month, You know, I was kind of expecting to see worse, honestly. It feels like that every time I go to the grocery store, you know. So there's no doubt that just getting by and buying the things you did a year ago cost you more this year.
I was laughing after this article, Dan. As you know, at the end of this thing, it talks about how, you know, the prices of eggs have, you know, spiked nearly 60%. It starts digging into health care is $17.97. It sounds like per month higher. Entertainment's about that as high as well. It gets into everything from alcoholic beverages, you name it. But then it goes on to say the bright spot, the bright spot is gasoline. Which I still almost choke on saying, where the typical family saved $1.55 per month compared with the year before. I was just thinking to myself, but it's still double from where it was the year before that. so I'm like, that's just the bright spots, gasoline, everyone. Just turn off the show. Just go home and be happy.
With your $1.55 a month, you know,
Yeah.
enjoy that as far as you can.
Or your $2.67 more a month alcoholic beverage costs that make you feel good about it, I guess.
You know, what's funny is to me, there's no longer a category of like tobacco in there, even though that's been one of those kind of, well, not inflation proof, or recession proof, but that's been historically one of those stock areas that people will invest during periods of recessions. Why? Because people during recessions still buy tobacco and still buy alcohol. And anyways, it's also been a category that historically has made the mark, but doesn't anymore. And that's that's kind of interesting. The U.S. has changed a lot. Worldwide, there's still a lot of people that's, you know, smoke tobacco, and people do here in the U.S. as well. It's just changed a lot from what it used to be, and not even that long ago, 5-10 years ago.
Well, it's become a little bit of like a not cool thing. You know, it used to be cool to smoke, so everyone smoked, and now, you know, it's like it's not cool to smoke. So, you know, so it's changed that wave of the world and the perspective of what tobacco is in the United States, and then they created like vapes. Yeah, I'm not blanking on it. You know, it's like to mitigate all the smell of tobacco. I mean, that's really what it's all about. So it's kind of interesting how the world has just cycled, but it's a drug like anything else.
Yeah, it's amazing. This is random. It just came up, but you know, we had some snow this weekend, so there was lots of kids' movies going on, and you know, even in kids' movies from the 80s and 90s, like I have to explain to my kids now, they're 5 and 7, there's a ton of smoking going on. And, you know, it's a good thing the way they look at it and ask about it, because it shocks them, you know, that the society's changed so much that, you know, it was just so common. I mean, at the dinner table, anywhere you went, people were lighting up. And now it's, you know, if you even catch a whiff of it, people are looking around like, you know,
I was a kid, they were smoking on airplanes. I mean,
it's crazy. Yeah. It's a good thing, though. That's a good change.
You know,
not a lot of them, but that's one.
You know, you're really hoping that they're like reviewing the airplane safety and going through that airplane when you still see like the tobacco, the ashtrays.
The ashtrays on the armrest.
On the armrest, you're like, oh man, how long is this thing?
This is an old bird. Yeah.
Guys, I actually have some really funny stories about visiting the East Coast, and smoking being one of those that was a part of that. But I'll save that for another show. I will leave this last thought. If you take a look right now at the television and you were to see an advertisement for, you name it, whatever pharmaceutical is being advertised to us today, and then were to compare that to, say, I don't know, 1980s or 90s when there was actually commercials for tobacco, is there any difference? Can you actually see a difference in the imagery? Because to me, they look almost identical. They sell lifestyle with pharmaceuticals today as opposed to what they used to with tobacco and alcohol.
Agreed.
Next up, do you guys remember the movie Goonies?
Of course.
I do.
Okay. All right. Some of us might consider that a generational thing. Others might say, no, that's a timeless classic and everybody should be familiar with it. At least that's maybe what we've impressed on our children. Anyways, article by Kyle Melnick here says that in January, after closing on the house from the Goonies last week, Beeman Zakari set the property first guidelines. Guests, so these are the guidelines to enter the property now, is that guests are encouraged to do the truffle shuffle when entering. And if you're not familiar with what the truffle shuffle was, that was a dance that Chunk was forced to do to perform in order to gain access to the house. Now, this was a 1985 movie, The Goonies, if you're going back and trying to reference what this is, that Zakari bought for $1.6 million.
Is that a lot for that area, Seth?
Yes. For this house, I would say yes. It's quite a bit. It looks a bit as it's kind of an average home on the coast, which that's the town that it's in is Astoria, Oregon. It's a beautiful home. There's no doubt it's a beautiful home. But this was, I would say, probably on average around a $500,000 home.
Wow,
that's a pretty good premium for the history of it.
I don't know. I love that movie. I remember I watched that movie the first time I was sick on the couch. My mom brought it home and I watched it, and I remember feeling a lot better after I watched it.
I'm trying to remember because I've talked about it with my wife about like when's the right time to show it. I know I got a 7-year-old, but I think it still might be a little early. I don't know.
We tried to roll that out with our 10-year-old and 6-year-old this last year, and it was a little scary for them.
Yeah.
Every kid's different. I wasn't that sensitive at that age, but and I have to remember that about my kids, and that's a good thing. I appreciate that they are more sensitive. I'm sure that's going to have some benefits for them.
That's all right. You can be overprotective. I was showing it at 2. There's a lullaby at my house.
Well, you come from a long line of pirates, so I guess that makes sense.
All right. Next up. Forget inflation. It's all about earnings. This is by Nicole Goodkind. It's another CNN article, which I'm not still an objection to, but whatever. We'll continue moving forward with Dan. I love teasing Dan on that. Hey, there's been a lot of change, and a lot of people have been talking. There's so much going on with the Fed. There's so much going on with all of it. But the truth is that pretty much the market has been singing irrelevant of what the Fed's going to do. The Fed has said that we are going to raise rates repetitively through the year to combat inflation. But this article is all about the fact that it's all about earnings. And they're talking about between the sinking of Disney, Meta, or formerly Facebook, shares at 13% and 24% respectively, and Palantir 11% down since November, that they're literally looking for all the CPI data and literally just looking at the earnings piece of this to figure out where the market's moving, which is what they're claiming that is why the market is moving up right now and in a trend that way, even while the Fed is saying that they're going to raise rates repeatedly. What do you guys think of that?
Yeah, I mean, I think the article does a good job of backing it up by, they make reference to a couple of particular stocks that you just talked about there, Ben. But in general, they're seeing the reaction by the market on an earnings report to be on an individual stock basis, roughly twice of that of what a Fed report has been, resulting in on the S&P 500. So, what that tells you is that kind of the mentality of the market's moving on. They've understood the inflation condition that we're in. Everybody knows what the Fed's up to, and they can kind of look forward and not exactly predict those things, but there's a comfort level built into the market now about the direction the Fed's moving and what their goals look like. So kind of the more relevant, the more reactionary story, the element that's moving the market more so than the Fed at this point is those earnings reports.
Well, I think the thing that's really going to throw this article off is if the Fed gets more aggressive on raising rates because they're not seeing what they want to see in the job market and so forth. That's the scary piece. A lot of people, I think there's a 90-some-odd% chance or predicted chance that the Fed's going to raise by a quarter point. But everything Jerome Powell and everyone else has talked about is that 50 basis points by no means is off the table. And if we saw a 50 basis point or a 75 basis point at any time over the next quarter, I think it takes the earning issues back into account, big time.
Yeah, for sure. 75 would do that. I mean, that would be pretty shocking. Anywhere between the 25 to the 50. I know the bet is kind of on 25 basis points, but I don't think 50 would shock me the way they've been behaving, though.
Yeah, I think we're going to get 50. I think it's. I think they're not seeing the numbers that they want, and they don't like the fact that the market is having these micro rallies that they're calling them that they feel is not healthy, and they're going to control that. And they've said that they're going to control that, and that scares me because I think we can. The stock market can be very naive to things, but is the worst priced in? I'm not there yet. What do you think, Seth?
Yeah, neither am I. I think it's an interesting kind of like a back and forth that we're seeing between, they call them the market makers or, the money of the market, and the Fed. The Fed has their idea. They've got this big picture, and there's nothing wrong with what they're saying and what they're wanting. And then the market's saying, hey, look, we've still got a lot to look at here that we feel is really positive. And until, I think that's kind of what they're putting out there really is like, until they start to see these earnings come down, they're going to continue to put their money right there.
And we're still dealing with a 200-day moving average issue on the S&P 500. It's still not cresting that, and that's a problem. And I think a lot of people aren't really giving weight to that. As we sit, a big chunk of our S&P holdings is still sitting in treasuries. It's not worth taking the risk for a small amount of yield when we can make. We're making money in the treasuries, and we're making pretty decent money in the treasuries.
General market especially. I mean, if you're taking a look at the broad index, S&P, Dow, whatever, Russell 1, 2, 3, whatever you want to put it on out there. It's like you said, there's so much risk on with that, given what we have as far as the market's momentum, the amount of money that's being pushed in. It's just not there. It's not really supportive of putting that risk on a portfolio, being more of a picker, being more selective, understanding the fundamentals around, what it is that you're buying on individual stocks or bonds or treasuries or whatever those places are, makes a lot more sense right now than just kind of throwing it to the wind.
Yeah, no, obviously we work together. I totally agree. I do think that, the tech sector, the triple Qs, I think they've just been beaten down so bad that even if you haven't found the bottom, like at the end of the day, I think 5-10 years from now, it's, you're going to wish you had bought any time around this period. So we can't really predict that. And it's really about being in the market. So from a perspective of investing, we're passive investors, and we truly believe in that passive space and allowing the market to do what it does. But we have an active touch when the market has certain cliffs that you cross. And when you cross a certain cliff, it's just better to be out than to be naively in. And so we use those cliff, kind of catchers, those kind of nets that we try to build, 200-day average being one of them. And then we look at certain drops at certain percentages and say, this is a reasonable time to take a position because somebody else has a position much, much higher than this. And so you have to kind of evaluate that and then look at the long-term development. I think tech and triple Qs, I just think there's just so much long-term potential growth that whether we're 5 or 10% above the bottom at some of these entry points, it's not going to matter long-term. And I think that's some of what you're seeing in the tech space right now is people taking positions, and we're getting a little bit more strength there. But other than that, I think the S&P, that could really hit low 3,000s, and that's there's a lot more to lose than there is to gain, and sitting in treasuries right now is not a bad idea while the Fed's trying to figure this out over the next quarter.
Well, that's going to do it for us on Money on the News. You're listening to Money on Tap, and we're going to be talking about tax changes for 2023. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Don't go anywhere. We'll be right back.
Hey folks, Seth Krussman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And folks, today we are talking about tax changes for 2023. There's a lot going on this year in the tax code. And it's a landscape that we work in daily, and it's a part of what we do as tax incentive planning and tax incentive planners at Brayshaw Financial Group, is to take a look at the landscape and see, hey, if we can understand what the code is, then we can certainly offer more advantages to this year, the following year, and understanding how you're investing and what your planning might look like if you were to do some different things. And I love one of the ways that Ben talks about this all the time, and in taking a look at, like, for instance, if you use Waze or Google Maps or whatever your, GPS get from destination A to B to C is, and if you tell that, hey, I want to get there the fastest, usually the fastest, most direct, well, that's one way that you can get there. But then you can also put in some different things like, hey, let's avoid some tolls, or let's avoid highways or freeways, or all these different things that you can get to your destination in different ways. And depending on where you're at and maybe the time of day that you're traveling, that might make a lot of sense. And it's good to have the capacity or the understanding of what's out there and how to navigate through it, so you can get the most out of your hard-earned dollars.
Yeah, I know. That illustration seems to sing through for a lot of people because, toll booths are taxes, right? They pay for the roads we drive on, and it can be a hard and expensive thing, especially when you're crossing the George Washington, which I think was $40. I mean, don't quote me on it, but I think it was like $40 or something when I crossed it, or $35. It was a crazy number. And I remember looking at
one time, yeah, like you just go across one time and they ding you $40.
In the Easy Pass, I was like, that is horrendous. Because you don't even realize you're getting dinged.
Oh, yeah.
Yeah,
no,
that's
like, shocking.
Go easy. Well, I didn't feel so easy after you get the bill. So, we all understand tolls and how they work. And the truth is the government gives us all different directions that we can go. That's why the tax code is an interpretation. And the interpretation should be pretty clear, but there's lots of ways to file your taxes. And as you're going through that process, there's a standard road for everybody. It's the highway, the freeway, and everything. As soon as your taxes get a little more complicated, and maybe not a whole heck of a lot more complicated, but enough that you can start looking at different avenues, different roads, it might take you a little bit more time, but if there's a traffic jam on the highway, you still don't want to pay the toll, it still might be quicker, easier, and less costly. So, we are the types of people who try to provide you the old version of MapQuest, but in today's form of Google Maps, or Waze or whatever you're using, because even though, you use those services, you find yourself sometimes on the road and you say, man, this is quite the traffic jam I didn't expect to see. And that stuff just kind of comes up on you and you don't realize it. And the year's ended and there's nothing else you can do to go backwards. You're in the traffic jam. And so what we really like to try to do here in the beginning of the year is really just open up a number of tax law changes that can help you potentially foreshadow, what the taxes are going to be, both good and bad. And we have some of all of those, which is great. And I think between both the federal, we're also going to cover some state stuff in our next show as well, which is relevant to a lot of our state listeners and so forth. We have clients all over the country. So, we're not going to cover every state, but we have a couple of marked items that are interesting. But there's a lot to this. And I think, digging through your taxes is not something anyone wants to do.
No, I mean, it's generally not thought of fondly, right? Tax day, and you're going through the process of getting prepared to submit your documents to whoever does your taxes if you hire someone to do it. I mean, every part of the process just really does feel painful. But there's certain things we can do to alleviate that pain. And there's certain structures and rules given us by the government that are kind of laid out there. And I think to be interpreted is a good word, Ben, a good way to look at that. But inside of those things, for some of us, there's real opportunities to save or do things a little bit more efficiently particularly around gifting and estate tax planning and issues like that, where you're looking to be philanthropic and benefit others. There's better and best ways to do that, and we're an organization that kind of prides ourselves around trying to show you the best way to get that done.
Yeah, a lot of people don't want to address it, and tax incentive investing is us addressing it for you and really just kind of educating you through the process. And you sit down with us, we walk you through, hey, this is where you're paying your taxes, this is where you can mitigate it. All of it's legal, it's your choice, which road are you going to take? And some of it takes a little more effort, right? It takes effort to go to the, type in the address and so forth. Like if I drive to work, I hop on 93, I zip south, I know where my office is, but you know what? I don't always check to see if there's traffic. And I've been caught in a couple of pretty bad traffic events where I'm like, hey, for those local listeners, I wish I had hopped on Route 3 and gone up north. That way it would have been a lot easier. So there's always those things. But to get going, probably the first big change, which is a tax savings for a lot of our listeners, and this is a really important strategy, and we'll get to why it is relevant. The tax brackets themselves are going to stay the same. They're going to be the 10, the 12, the 22, the 24, 32, 35, and 37% tax brackets. But what they've done is they've increased the amount of income in each of those brackets by 7.1%, which means that in the 10% bracket, you're actually going to be able to make, I think it's up to $20,000 this year versus the 17 or something it was last year. So you can make more money in the lower brackets each year. So that's a tax savings. I think probably the number one reason you want to know these brackets, or what we walk our clients through, is when you're looking at RMDs, how much money you want to take, all the strategies around distributions. You might be in a certain bracket that you're like, hey, I'm taking in less than I normally would. I'm retired now. You might want to take a little more money out of your IRA and pay some of these lower brackets during these earlier years. So this is an opportunity for you to understand, hey, these are the levels. This is what I would pay. And the opportunity for me to take more money out at this lower level may be a real benefit. But knowing the cap, you don't have to take too much out.
Yeah, and I think some of these increases are pretty generous. I mean, if you think about it in terms of how much money a couple married filing jointly would be able to keep in sort of a lower bracket, this year between the 24 and 32% bracket based upon these changes, you'd have an extra $12,600 of income taxed at that lower bracket, which that's a significant savings. So there's a good opportunity there if you're looking at things like RMDs, Social Security, but as well if you're kind of on the younger end of the spectrum, pre-retirement and considering a Roth conversion.
Yeah, and that's $1,000 tax savings.
Yeah,
I mean, in that increase. So that's a pretty substantial opportunity, roughly.
Number two, the standard deduction. Joint filers who don't itemize deductions on their return for 2023 will see an $1,800 reduction in their taxable income compared with a year ago. So for a married couple in the 24% tax bracket, that puts roughly $425 to $450 more in your pocket. And, most people are in that category of not itemizing deductions anymore just because of the changes from Trump and how that all worked out. It didn't make sense, and there wasn't any benefit after that.
This is one of the biggest Trump benefits tax-wise, I think, that ever happened for the average, kind of Joe out there. I mean, for people who don't itemize, they literally doubled it. It used to be like $6,200. They went to $12,400 immediately, and then for couples, it used to be $12,400, and I think they went to $24,000 or something like that. It was like they doubled both of them, and that was huge. And they've been carrying this forward. And the thing is really to have $24,000 married filing jointly, to have $24,000 of deductions between health insurance and everything else. They took it, I think, don't quote me on it, but it was like over 20%, 22 or 23% of America itemized their tax returns. It was like almost a quarter of America. And this dropped it below 10%. I mean, it significantly reduced the number of people who had to do, long forms in the filing process. I think
between this and the mortgage deduction, I mean, those have to be the things that touch the most people, right?
Yeah.
So it's a great benefit for all.
It's very, very difficult to go over those itemized deductions. Now, what's interesting about this is when you know this and you say, hey, I'm very charitably minded. There's a lot of different ways of gifting. So people sometimes will give, let's say you're giving $10,000 a year to your church, and then you've got, your house deductions, and you've got, some medical and so forth. you kind of hit that $20,000-ish range and you don't quite go over. But there are ways, and you can reach out to us where you can create gifting over a 3-year period, okay, that will go out to your charities of choice, but you can actually itemize them all in 1 year by giving to an organization that will handle the gift giving over the following 3 years. To do this type of gifting, we use what we call donor advised funds, and you can place all of your money into it and then give to your church or whatever charities you're going to give to over the next 3 years. And meanwhile, that, if you were giving $10,000 a year for 3 years or 5 years or whatever it is, you get $30,000 deduction this year plus your house plus this, and then you go over this automatic deduction the government gives you, so you get the full deduction of what you actually did. And then the following years, you're not displacing money from your account, but you're actually getting the full deduction that the government's giving you, and it actually nets you probably about another 10 or 20, whatever, if you do the math, $1,000 of whatever your other deductions are to net you more money. Things to think about, to give us a call on, but that's why these are important.
And next up, we got retirement plan contributions. For 2023, for 401k participants, you're going to be able to put into those accounts pre-tax $22,500, which is a $2,000 increase. And for those 50 and older, you can put up to $30,000. So pretty significant increases there from the contribution end. And as well for people who are putting money into IRAs, there'll be increases there as well of $1,000 per year eligible to contribute, for up to $7,000 for people age 50 and over and $6,000 for 50 and under.
I think the only thing I would add to this piece is, there's a lot of our listeners are self-employed. We have a lot of people call in on that space. And, there's other things you can do beyond, setting up 401ks and so forth to get these numbers. If your income's higher and you're really trying to adjust into those tax bracket levels we were talking about, like the 20 or 22, the 22 or the 24% versus the 32. Yeah, sometimes you'll add more to a retirement plan. So structuring the right retirement plan to start out your year is really good, and trying to forecast that so that you have the ability to have more bandwidth to say, hey, you know what, I might need to put more than 30 in just to keep myself in the 24% bracket, and that's a concern for me. There are other plans out there for you to consider.
Yeah, kind of understanding how these work differently from maybe some of the other tax savings ideas. They're familiar and they're common for us. We're working with IRAs and 401ks all the time. If you have an employer that has a 401k out there and they've got a match for you, that's one of the first places we go, is just say, hey, you've got some free money out there. Go get some free money. Take advantage of that. After that, if you're contributing towards your 401k, this is a tax reduction of the dollars that you are contributing. And this going up to possibly $30,000, or it is not possible, it's going up to $30,000 for over 55, 50 and over. That's a huge amount that you're able to kind of take off the books of your income.
And something else to think about too, and this isn't really IRS driven, but in the struggle to retain employees, companies have had to change their approach a little bit. So it also may well be a fact that the match has gone up where you work at. So make sure you're aware of the current stipulations provided by your employer, seeing if they've had any changes from their perspective on this. Because if you've been contributing up to the match and they've increased the match, you might want to roll up that contribution a little bit.
Yeah, and then I would say finally the thing to look out for is whether or not you're allowed to do in-service distributions. 401ks sometimes have limitations on the type of allocations you can do, the type of planning you might need personally. You might be approaching retirement, trying to strategize around that. Sometimes when you cross 59.5 or 62 or 65, they allow you to remove a portion of your 401k for your own allocation. And you could transition that into an IRA. That's, there's no taxable event there. But if that accomplishes your planning goals for retirement and trying to facilitate that, it can be a very powerful opportunity. That's called an in-service distribution, something you should at least be aware of, which means that you're in service to the company, working for them, but you can do a distribution of your 401k. And this is not a loan. This is a transfer. Sometimes they allow you to transfer what you've contributed, what you vested, and so forth. Sometimes it's based on age. Sometimes it's not. So
I just was working with a client very recently, and we were reviewing the 401k and the determination of whether they're eligible for an in-service distribution. And, I was really shocked to take a look at the plan, because usually these are, there's some standards around options that are supposed to be available to you as kind of a broad-based offer. But this particular plan had a whole series of those target date funds, which we've spoken about before and not necessarily big fans of. But they literally had, other than that, one S&P 500 mutual fund, one Russell fund, one small cap fund, and one emerging markets fund. And that was it. So that was an extremely limited offer.
Oh, yeah. I mean, if these employers knew, I think, honestly, if you're an employer and that's what you have in your plan, I think you're going to get hit with fiduciary claims on that. I mean, some of these companies say, hey, listen, we'll protect you fiduciarily. But I don't know that that's really the case because, one, when you actually start uncovering these target date funds, you realize that you're getting multiple expense levels on top of each other. They've got fund upon fund upon fund, and some of them can be so costly it's prohibitive. Secondly, if you don't really have the breadth or the bandwidth of lots of other options or reasonable options for someone who's more savvy, I mean, I have clients call me all the time. It's like, I wish you were managing my 401k. I'm just losing money left and right. That's a very scary conversation to have. And when employers start realizing, hey, if this recession, if this pullback is long and drawn out, and we're literally in the middle of the baby boomer retirement stage, there's going to be some very upset investors and some people very upset with their employers. So if you need help if you're a business owner and you need help, you want to have a conversation about your 401k plan and why that might be a risk or an issue for you, give us a call. I'd be happy to chat more about that.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about the 2023 tax changes. Lots of them coming through this year. And if you're not aware, you want to be. You want to be in the know on what some of these things are, because planning today is going to allow you to take advantage of these now and in the future. We're going to take a quick break. We'll be right back. You're listening to Money on Tap.
Call us today at 855-226-8551 and get your free consultation with Ben Brayshaw or Seth Krussman or any one of our partners and find out what's going on in your plan, your estate plan, your financial plan, or what you're planning at all, if nothing. Get it fixed, get it right, get it done today. Give us a call at 855-226-8551.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about 2023 and tax changes to the landscape. What's possible in 2023? And we have covered so far your retirement income or your retirement contributions and the standard deductions that they've raised there. Some of the things around the tax brackets. There's a lot in the code this year that they are changing and quite beneficial. Along that, are you familiar with the HSA or the health savings account? They're raising your contribution limits there, which is a triple threat as far as the tax code goes. And what do we mean by that? Well, you're not only getting the deduction on the way in, you're also able to invest your HSA, and those investments can grow tax-free. And then your distributions, if you're using them for qualified distributions, are also tax-free. There's really nothing else out there like the HSA. It's a beautiful part of what's available in our tax code, and I'm happy to see that they are raising it by $200 for the individual.
Yeah, I mean, I'm a big HSA fan. I mean, I try to make sure I max that thing out every year. We got family health insurance, and people who need care, and Dan, you as well. And so, there's just a very, very intentional reason, that I do the HSA, but I do try to get it invested, or a portion of it, and we can do that here. I mean, that's actually one of the things that we provide. We have an HSA provider, and then we can move it into a brokerage account. We can invest portions of it. And actually, over the years, I've seen people start coming through the door with actually fairly large HSA accounts, which it's become something. And if you don't know what a health savings account is, we've done shows on them, and we've talked about how it's like the triple threat version of tax friendliness. And you don't pay taxes on the way in, and you don't pay taxes on the way out, and you can convert it to other retirement resources in the future if you don't use it, or you could use it for tax-free care and long-term care. You could self-insure through this type of scenario if you save long enough. I mean, goodness gracious, I think I just talked about a whole show right there. But there's so many different pieces to an HSA that if you have not considered it, you have not engaged with it, and you've got to make sure your plan actually allows it. But if it's something you can do, this should be a real primary, secondary focus of, hey, I did my retirement plan, I met the match, where am I going next? If it's not Roth, HSA, that's where a planner is going to come into anyone's conversation. But this should definitely be on the table of conversation.
Yeah, and one of the things that's interesting about it, too, is understanding what your deductible is and what the options are for the health plan that you choose at your company, because you can use this HSA to kind of manage your way into a lower monthly expense, but at the same time knowing that if you have an expense coming your way, a medical event, that you'll be covered as completely as you would otherwise. So there's a lot of techniques to it. And one point of clarity, this is not the FSA, which is a different style of account earmarked for medical expenses. But, in that one at the end of the year, if you haven't spent it, you lose it. And there's significantly more limitations around, what are qualified expenses. So big differentiation point there. HSA is definitely something to take a good long look at if you have one offered to you.
The Earned Income Tax Credit. Now, this is a credit that's for low to mid-income families with 3 or more qualifying children. The maximum Earned Income Tax Credit is jumping to $7,430 from $6,935. Credit reduces your tax dollar for dollar. Even better is the refundable tax credit, which means that even if you don't owe any tax, you can still receive a refund.
This is something that's utilized by a lot of families, a lot of people, because it's, you may not even have any deductions and you're getting this money back. It's literally a credit. There's a difference between a deduction and a total tax credit refund. And this is something that, you can strategize and try to get yourself, like if you're close, you can strategize potentially with retirement plans and different things to try to get yourself into what we call the EITC. And I would encourage you that if you haven't, give us a call. And if you're struggling with, making ends meet these days, it's worth looking at each and every one of these things.
Yeah, particularly a refundable credit. I mean, that's money directly back to your pocket. So if you're on the cusp of that, or just want to get a better understanding of it and potentially find a way to manage your way into the credit, we can certainly help you with that.
Yeah, absolutely. Is this like the 6th one I think we have? We have quite a few here. But the alternative minimum tax, the AMT, this is kind of a nasty word. A lot of business owners go through the testing of AMT. You start hitting certain thresholds, and the government says, well, we want to test your overall income. We're going to add some things back in, and we're going to give you a certain deduction and XYZ, and next thing you know, they have this like added nasty AMT tax for a lot of people. The IRS has raised the income threshold for AMT from the $118,100 to $126,500. So testing's a little bit more friendly, like starts a little higher up the ladder, and that's something that's worth enjoying if that's where you're at. And this can actually hit a lot of self-employed business owners. Unbeknownst to them, at the end of the year, they're like, or come April, they're like, where did this additional tax come from? And the first education on that is quite painful.
And up next, we got state taxes, where the exclusion for 2023 is going to be increased to $12.92 million, up from $12.06 million, which is an additional potential $860,000 of total wealth that would not be taxed for someone who's in the 40% bracket. So that is a really significant increase for those fortunate enough to have estates that size and are concerned about passing that estate on. You've gotten a very generous benefit here for 2023.
I think the thing about the estate tax that a lot of our listeners, $12 million is a lot of money. And that covers a vast majority of Americans. And then when you start adding husband and wife and doubling that number, 24, 25 million, it's kind of unfathomable in most people's mind that this is an issue. But that's not the problem. The problem is this tax law is not set in stone. A lot of people don't realize this thing 20 years ago was like $600,000. Yeah. And this is the federal estate tax. This is not the state's estate tax. And so a lot of states start at $1 million or, $1.5 million. I mean, they're all over the place, and where you start paying estate tax to the state you live in. And that can create a lot of complications. We've had some attorneys on our show. We've talked about this. And we're all of the mindset that, the amount of debt that our government has written, the 10, 12, whatever trillions of dollars of additional debt they've written in the last number of years, has to be accompanied by one of two things, either lower spending or more income by the country. And the only way they get more income is to tax us more. Spending doesn't seem to be going down, and taxation looks like it has to go up. I mean, you can't keep spending money and not making more. So it's a way of life. It's every credit card out there. It's every conversation in a household. And so one thing that happens in this country is dead people don't vote. Well, and that could be questioned across the board, right? So, but some dead people don't vote, and they don't get to vote on their estate taxes. And they worked really hard for this money, but kids inherit this money, and they're just happy to get more money, and there's nothing they can do because the book is already written. There's a lot of things you can do about estate taxes, but I do believe that these $12/24 or $25 million deductions are going to go back to the wayside, and they're going to reset. They're going to reset to much lower values, where we used to work with clients doing credit sheltered trusts or AB trusts. And I think that's coming back to play, because I think this is one way the government will be able to touch their hands on the generational wealth transfer, which is the largest transfer of wealth in history, is coming up.
I think politically speaking, this is the one that always comes up, right? This thing is always under attack, and I've seen it proposed, relatively recently, bringing it all the way down to $1 million.
Yeah.
I mean, if you're fortunate enough to be in a position where this is a concern, be concerned.
Well, and if they even have brought it down to $1 million, the taxes on everything above $1 million is like near 50%.
Yeah.
I mean, it's like if you had $10 million, you're kissing $4.5 million away to the government. It's crazy. And there's a lot of techniques and strategies that we implement to help minimize this. And if you're not thinking about this today, and you're saying, well, it's $12 million or it's $25 million, I'll deal with it later. Well, it's actually better to deal with it now. And those are things that can be discussed.
The gift exclusion is what's up next. So if you're in this bucket where you've got some of these estate tax questions, and Ben was just articulating some of them, one of the strategies that may come up for you or be recommended is a gift exclusion. And the annual gift exclusion has increased to $17,000 from $16,000. And it seems like this is one that's continuing to be raised regularly. I mean, it was 14, 14 and a half, 15. And basically what you're able to do is give away the money before you die. And that's one of the ways you can, move money over, not have to pay the taxes on it.
Yeah, I think, and you can give $17,000, to anybody. I mean, it's not just your family. You could give it to each grandchild. You cannot
give it to Ben or Dan or I.
Yes, you can. Well, you can if you were not a client. So, I mean, if you need people for that list, you add us right up there. So
always available.
Always available. So, but the thing is the husband gets a $17,000 gift to their child, and the wife gets a $17,000 gift to your child. So that's $34,000 you could give to each child. You can give it to each of your children, each of your children's children if you want to. And that line goes on and on and on to all the way to us. And so, I mean, it's a pretty generous gift, and something that has much more versatility than a lot of people use. We encourage people to use it a lot for, ILITs, irrevocable life insurance trusts, where they can gift money to their children to buy life insurance that would create tax-free benefits. Here you're giving away the money tax-free. It's going into a program that's going to amplify those dollars even further than the gift was. And so it's a pretty opportunistic way of kind of mitigating some of those overall tax laws. No taxes across the board through all of those transitions, which is really great.
And a lot of people simply want to enjoy the gifting while they're here to witness it, right, as opposed to leaving it in your estate and having it pass through that way. you can have a little bit of fun with it and be here to witness and just, get in on the joy of giving.
Yeah, there's a lot of things we've done. We helped a client set up a dynasty trust through some gifting and pre-gifting some of their estate and so forth. And that was kind of a fun experience because they were able to really have conversations with their family, why they were doing it, what they were doing, and then they used the gift exclusion as well during that time to communicate some of that. So that was neat. It was a kind of a two-part thing.
Folks who are listening to Money on Tap, you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about tax changes for 2023, and we will be right back.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We've been talking about the 2023 tax changes. There's a lot of them coming up here, and most of them are just nice, healthy increases on what we've been allowed to do in the past. Historically, we've used the IRA, the 401k, and a lot of these different pieces to, put together the picture of, the least amount of taxes possible, usually one of the goals for us to have you, pay, but also taking a look at just a healthy balance for you of how to put these pieces together to accomplish your goals. Not everything is always going to be pay the least amount of tax possible when it comes to planning. And, just for instance, if you're a business owner and you want to buy some real estate and you want to do that through traditional lending, you're going to want to be able to show some income there. It's just what they're going to want to see. And if you are putting everything over here in this direction and you're, writing everything off, well, then that's not going to accomplish your goal. Just one thing out there out of many. But this puzzle that we're putting together for you is one of the things we want to try to accomplish when we're doing some planning here with you at Money on Tap.
Yeah, I think that's really well said. The only thing I would add to that is that, for a lot of people, understanding when to pay taxes and when not to pay taxes, or when you can choose not to pay taxes, is really where you empower yourself differently, where you are able to really define your financial status inside all of that. Sometimes, like you said, Seth, paying taxes really makes sense. It's hard to even say that, feeling good about it, but I kind of regret where half of my tax dollars have to go. But there's a point in time where you can choose to bite the bullet the right way on this type of thing.
And that's why I think, the tax code is important for all of us to know, because it's the rules we all, financially live by. But how do you apply that is very much personalized. And it takes some expertise to make sure that the decisions around when to spend, when to earn, how to show those earnings, or when to take a deduction is of significant value to you and has a big impact on the bottom line. And that's what we're here to do. That's the kind of coaching that we can offer you, is to, how to best get you to the outcome that you desire, understanding what all the inflows and outflows look like, and the fact that we've got this, participant at the table who's here to take their piece, and we want to give them, the just piece, but the smallest piece we can.
I love what you're saying there, making a choice versus having the choice made for you. And that's what a plan can do for you. Folks, you're listening to Money on Tap, and we've been talking about the 2023 tax changes. You can reach us at 855-226-8551 or info@yourmoneyontap.com. folks, be successful in your investing. We cannot wait to meet with you and spend some more time with you here next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.